So hi guys, welcome back to another video. So in this video I'm going to introduce you to how I develop playbooks. Over the last like 3 or 4 years I've been trading mainly one playbook, and I think I've gotten quite good at trading that specific playbook. However, it's always nice to develop other playbooks. I tend to believe that if you'll have a very long career in trading, it's good for you to be good at 2 or 3 things, because sometimes you'll find that what works in one environment might not work in another environment, or rather sometimes you improve the chances of you generating higher returns by having different playbooks. And so for me, what I've decided to do is to copy what Caleb does. So I'm copying his playbook. I'm trying to, however, customize it in my view, or in how I think it should be working. So I'll come up with different entry triggers, I'll come up with different exit triggers, I'll come up with different filters, I'll come up with different watch lists that I'm looking for in this particular playbook. But the idea behind the playbook is quite the same. Hence the reason why you'll find that two people can be both trend followers, but the idea of following the trend is very, very different. Or two people can be contrarians, but the idea of going against the trend is also quite different. However, by the end of the day, whatever field you go to, I think the fundamentals of how the financial markets work will forever remain the same. Number one, it's all about your strike rate. How many times are you right? How many times are you wrong? Whether you're trading based on cyclical patterns, whether you're trading based on value investing or value analysis, whether you're trading based on technicals and looking at a chart, whether you're trading macro news and macro changes in the fundamentals, all these things, we will fundamentally boil it down to the first important question: how many times are you right? How many times are you wrong? That's your strike rate. And the second variable we'll be looking at, for example, is the R multiple, or the risk reward relationship between the two. Like for example, I've been looking at seasonal tendencies in the stock market, and I've realized that even in that particular arena, they tend to work about 50% of the time. But when they work, if you look at the risk reward multiple, it's about 1:4, whereby a 3.5 loss is normally averaged with a 14.8 return. So by the end of the day, if you're going to spend time in the markets, get used to losing, get used to winning. And what really matters is what is the size of your wins and what is the size of your losses. I think it takes years for someone to really ingrain that into their system, and for someone to fundamentally understand that. Not just to know, because I know very many of you know, but I feel like majority of you still don't understand, especially if you're still struggling with your trading, because it's only when you don't understand that's when losing will be somehow hectic for you, or you will be disturbed by the idea of losing. But if you understand those metrics, it will be quite easy for you to lose and still come back in the markets and continue trading and be comfortable with drawdowns, be comfortable with the up periods.
Now, thanks to Paperstone, Financial Hub is going to be having live trading sessions on Tuesdays every week. Mind you, this is not a signals group. This one will be specifically for anyone who's deposited their money using our link with Paperstone and deposited money in their own account. Now, if you look at the description below, there's a link where you can open a Paperstone account. Once you open a Paperstone account, you deposit either $100 or $250 to get the top tier access to the financial course, which you get to understand how we trade. What will the students gain from all this? One, you'll gain clarity in the process. Patience training. We'll be teaching you a lot of patience training depending on the time frame you trade, the pairs you trade. Risk management in action. We'll be talking a lot about the trade management skills and how I manage a trade. We'll be looking at real market conditions and experience the market as it is. And I'll see you on the other side.
So to start off, I'm going to look at the different playbooks and how you develop a playbook. So what's a playbook? Fundamentally, a playbook is basically a set of rules or a set of filters that you have placed for yourself that dictate when you'll be in and out of the market and why you should be in and out of the market. For example, like for me right now, what I'm trying to develop a playbook around is trading flags. And flags are essentially a correction pattern. And what basically flags are is basically you'll have an impulsive leg, you'll have a correction, and then you'll have another impulsive leg. So anytime a trend develops, the corrections will sometimes come in the form of a flag pattern, okay? And a flag pattern is basically an ABCD pattern, which if you look at the Fibonacci ratios, it should have at least a retracement and an extension to the 1.272 extension. For those of you who are not familiar with that, just use artificial intelligence, use Google, and you'll be very quickly familiar with what I'm talking about. And then when markets correct to either a 50, 61.8, 78.6, depending on how big the retracement, we then get an extended move to the upside. And what I'm trying to do is to look for buy opportunities when we get that extended move to the upside. So what do I need to do? The first thing I need to do is to develop what defines a flag for me, because again, it could be the same pattern, but the metrics that you use to define a flag are quite different. Like for example, for me, I'm not looking for flags on the 15-minute time frame. I'm not looking for flags on the lower time frames. I'm specifically focusing on the 4-hour time frame because that is my sweet spot. That's where I find good opportunities, and that's where I'm able to make good money. And so I will first define what a flag is. And so if you look at what I've written down here, I'm trying to use the scientific method. So the scientific method is a method of research. If you just check the scientific method, it's a method of research. And basically when you're doing research on something, there are three things that you need to do. One is you come up with a hypothesis. For example, you might say that my hypothesis is every time I've observed an impulsive move followed by a correction in the form of a flag, we tend to have another impulsive leg following. That's an hypothesis. That's an idea, okay? But then that idea will have statistics below it. So yes, it's true that probably when there's an impulsive leg and it's followed by a correction in the form of a flag, we're likely to get another impulsive leg, okay, to the upside. And that impulsive leg to the upside is called a trend continuation or a trend movement to continue. And so when you get that trend continuation to the upside, we tend to move to another fib extension on the upside. And so that one now becomes impulsive correction and then another impulsive leg. And so that one is now known as a flag pattern. Okay, so what for me defines a type 1 flag? In order to potentially head for good setup, we must pay attention to some critical definitions. One, a type 1 flag is defined by price action opening around the fair value area and rallying towards either R2 or S2 level to form the CD leg in a flag pattern. Often it appears after a failed third bounce, which is a trend following pattern. So like for example, if I open this chart here, you'll see that this is an example of a type 1 flag. Okay, so let me just double click for it to be zoomed out for you to see. Yeah, so like this one here. So you can see that this is an original impulsive leg to the upside followed by a flag pattern. Okay, so you can see this was a correction. Okay, and you can see markets bounced off, but what happened is markets did not attain my target. Instead, the market continued moving lower. So this was a flag. It worked well, but it did not attain my targets. And that is the thing that you must get used to, because I feel like for most of us, we're looking for that thing that will work all the time. It does not exist. The only thing that happens is you'll get variables whereby when the trend is moving to this particular direction, there's a 60% chance that when this happens, you will get a move to either direction. So like here now, you can see that we had this drop, we had this correction in the form of a flag, and then we had this drop, a risk reward of about 1 is to 2.66. And so what you do after you form your hypothesis is you go now for the second thing, which is data collection. Okay, and so what data collection is all about is going into the markets, looking at historical price movements and what they have done, and trying to access what patterns exist and if those patterns are really profitable. Because the only thing we're looking for as traders is statistically reliable patterns. Whatever methods you use, statistically reliable patterns that if you can execute them consistently, you will have a net positive return. Hence the reason why by some returns that people want to talk about are not realistic, because the statistically reliable pattern cannot give you that return. Okay, so once you go through the data collection, which is now whereby you collect as much data as you can. Like for me, I like collecting data for around 10 to 15 years. Why? Because I feel like in that cycle, I will have down markets, I will have up markets, I will have quiet markets, I will have volatile markets, I will have bullish markets, and I will have bearish markets. After collecting data in all these fronts, the next thing that I'll want you to do is to analyze that data. Okay, so sit down and analyze the data, do the cyclical analysis of the data. How many times are you right, how many times are you wrong, what is the average risk reward ratio? Okay, which days are the best for the particular setup? Like for example, in this setup that I was looking at, it normally doesn't work very well in the beginning of the week. It does well probably between Wednesday and Friday. Hence, I know that if I spot this pattern and it's on a Wednesday, it has a higher probability of playing out than if it's on a Monday. That's a variable that you just key in, so that you get to that point whereby now you have filtered and you have the A++ setup. Like for example, once I'm done collecting this data, I will now come up with valid rules on how to trade around this setup. Like for example, I might say that if this setup appears on a Monday, don't take it. But if it appears on a Wednesday or Thursday, please take it. If this setup has a risk reward ratio of less than 1:2.5, don't take it. But if it has a risk reward ratio of more than 1:2.5, you can take it. Okay. If this setup attains a particular level, you're allowed to exit if it shows any signs of a reversal. If not, don't exit. And so once you do all that, now you will come up with a specified method that allows you to get in and out of markets, and that you have collected data on, so that you're confident about what you're doing and you're not left to the impulsive whims of what the markets are doing. Because without a clear playbook and without clearly defining what you're looking for in the market, it will be quite hard for you to be confident, especially when the losing trades come. It will be quite hard for you to be disciplined, especially to wait for the right thing for you to do. And these are the reasons why most trading firms will tend to more or less represent themselves or want to be known as research firms, because research is what essentially leads to trading. Like I like what Ken Griffin says, who's the founder of Citadel. He says Citadel is a research firm with a product in trading. So if you think about that, what that generally means is they specialize in researching what prices are doing, and then their product is now trading those prices after researching. And I think everyone should adopt that model, because by the end of the day, what you're really doing in trading is researching statistically reliable patterns and then implementing those patterns. If you're not doing that, then you're basically a gambler, and there are very many gamblers in the market. People who wake up and decide today it's going up, let me buy, tomorrow it's not going up, let me sell, and all that. And after doing that for a long time, you'll realize you can't make any money, at least consistently. So very important for you to know the variables that you're looking for you to go through the process of testing them, and for you to have conclusive data, failure to which you are not allowed to trade that particular instrument. So for you to succeed in the markets, make sure you sit down, calculate, and work around those things, because failure to do that will mean that things will not generally move your way. So that's a brief introduction into the scientific process and how you can develop your playbook. You can do more research on what the scientific process is and how you can apply it in your own trading, including writing prompts on this is my playbook, this is scientific process, I want to merge them. ChatGPT will come up with very clear answers on how you can do that, give you very good filters that you can use when you're testing, and help you to develop. And this will really help you to grow and to come up with a refined edge in the markets. So take your time, develop those things, and that's why you'll find that sometimes traders will say, like for me, I'm not yet trading flags. I was trading them, but then I realized I'm doing the wrong thing. You shouldn't trade any setup without testing it, no matter how good it looks. Always test before you trade. Without testing, you can't trade. Always test before you trade. So with that said, I think I'll stop there. We'll catch up next time. Peace.